Hello, I'm Vittoria Logli with @Properties, and I'm here with Brian Jessen from Guaranteed Rate and Evan Fitzgerald from my team, and also @Properties. And today we're going to be discussing the hot topic of really the year, rising interest rates. And at the end of the talk, I will actually be answering a question that I'm getting from everybody in regards to interest rates and real estate. So let's dive right in.
Yeah, and really, I think the thing that everybody wants to know is what is the lay of the land right now? Things have changed so much even just from the beginning of the year. Where are we right now? And sort of give us a roadmap of where things are going.
Sure. So to answer that question, this year in 2022, interest rates are about 2.5% to 3% higher than they have been. What does that mean? It means probably high 4s to 6% on an interest rate. What does that mean going forward? The entity, the Federal Reserve, that sets short-term interest rates that doesn't directly affect mortgage rates is behind in raising those short-term rates. They should have started doing it last year. They thought that inflation was going to be temporary. It's obviously lasted and higher than they expected. So now they're trying to catch up on their short-term rates, and they're raising rates, but they don't affect directly what mortgage rates are doing.
Right, so like people are saying, oh my God, July, there's gonna be another increase in interest rates. Does that affect directly the housing, our interest rates for buying homes?
They do to a certain extent, but they don't. So they don't have a direct effect because those have been factored in. But really, we're close to the top on interest rates, and you should be optimistic longer term on interest rates. So some people are picking shorter term products now, like a 7 or 5-year ARM versus a 30-year fixed, because they're able to take advantage of a lower rate now there with the anticipation that rates will be lower kind of in the second half of 2024.
I just want you to elaborate that on a little bit really quickly, because if this were a year or 2 years ago, people weren't looking in that direction.
Right.
But obviously
like
the climate's a little bit different, and now there are other options that might make sense for them.
So the ARMs, like 7-year ARM, 10-year ARM.
Correct. So I mean, like they said, 2 years ago, rates were so incredibly low, historically low because of the pandemic, that everyone was taking the most conservative tactic because they were worried about the economy. They saw how rates were low, and they took the most conservative option. Some people,
which was a 30-year.
Which is a 30-year fixed or a 20-year fixed. But now, some people are still doing that, but a higher percentage realize on a longer-term basis that rates will probably come back down.
Or what are your best tips for them to be in the best possible situation to get the lowest possible rate they can?
So the first thing is to get with a mortgage professional that has experience, has been in up and down markets, that can guide you properly, honestly, clearly what your next steps are. Things like your credit score. You might think you have a good credit score. We look at your credit score and there's ways to improve it. So we would give you some advice on that. We'd refer you to a credit repair specialist that will give you a free review as to what you could do. And we could partner on that to look on a longer term basis how to get you a better credit score.
And this is a local credit repair company, not out of the country.
This is not someone from another country.
Actually, the guy lives in 𝐵𝐵𝐸, which is really nice.
Another thing is, what are you doing on your employment? How's your income been? Have you switched jobs?
Looking at the historical context of this.
Right.
Things are higher than they were, but they're not necessarily high when you look at where interest rates
for
have
the last
been
50
over
years.
The long term, right? And I think that that's something,
Now we're gonna be dating ourselves.
Yeah,
Let's just be clear, okay?
In fairness, this will be something that Vittoria, you can speak to too. I have never had an interest rate, and I've been buying and selling real estate in Chicagoland since 2011, 2012. So 10 years.
He's the youngest one.
Anyway. And the highest interest rate I think I've ever had on a mortgage is about 4.5, right? That is still a historic low, but my perspective is sort of in a very small range. Right. When I talk to my parents, when I talk to people who have been doing this a lot longer than me as far as buying and selling.
It was like 12 years ago.
Yeah.
20 years ago-ish, 22 years ago.
20 to 25 years ago.
6+%, nearly 7% when we bought our first house here in 𝐵𝐵𝐸. It just was.
My parents always talk about 11 and
parents, double
right.
digits, right, Brian?
Correct. So if you look at historically, the average interest rate historically is somewhere in the 5.5% to 6.5% range. We obviously were in the 2s, the low 3s. Way back, about 1980, we're talking about 15, 18%.
So when we bought at 6.5%, guess what? We refinanced. And that's an option, right? Refinancing when things do start to come down.
Yeah, and obviously, people ask us all the time how this is going to affect them personally in their search for a home as they're selling and looking for the next step. And I know that that's something that you
right. So the burning question I keep getting over and over, people telling me, so since interest rates are increasing, that means property values are coming down. No, that's wrong. There's not a direct correlation. Absolutely not. Not to say it couldn't happen, right? But we're not in a balanced market right now. We still have high demand. Granted, it's not taking 10 days for properties to sell. Maybe it's taking 30 days, but we still don't have enough inventory to meet the demand. A balanced market is 6 months of inventory. We are far, far from that. So the prices that you might see coming down is because, I hate to say it, sellers are getting greedy. You know, their increases of 20% over the last 18 months are already baked in, but they're taking the highest comp and then they're adding another 20, 30, 40, 50,000. It doesn't work that way. We've already seen the increases reflected in the sales prices. So if we're pricing in that sweet spot, there's not gonna be a problem. We'll sell it in less than a month. You know
And
what I mean?
two, if you have sellers that can't find properties that they like, they're like less likely to
100%.
list their property because they can't find something.
They're like,
they're
let's
worried,
try it too high.
and they're worried about if they
Yes.
sell the property, they won't have any place to move to.
That's a very big concern, absolutely. So we're definitely low inventory here, and I hope you enjoyed this. Feel free, please comment, send me a DM questions about, you know, anything real estate related or interest rate related. Thank you so much for joining us, and we're excited to see you next time.
Bye now.